Hi folks, Marc here from Able Capital Partners, and today we're going to talk a little bit about the insights and the takeaways from the CBRE second half of 2022 cap rate survey. Now this is a survey that CBRE puts out twice a year where they basically go out and ask their own professionals at CBRE, a huge national brokerage, a bunch of questions about where they see the market and expectations going forward. Now in this case, they surveyed around 250 of their own professionals covering across more than 50 geographic markets within the US. And the purpose of this survey, again, is to generate insights from the data that they gather. In this case, they were able to gather around 3,600 cap rate estimates from those respondents. So before we dive into the survey, we're going to take a step back and look at what happened last year. So unless you've been living underneath a rock, you know that last year's Fed rate hikes and the rapid rise of interest rates in general has had an effect on real estate. Now, we saw at the short end of the curve, rates back up around 400 to 500 basis points, depending on the point in the curve. Now, what does that mean for us as investors? As investors, we are levering our returns. We are using debt to magnify our returns. And the more expensive that debt becomes, really one of two things can happen. One, we either need to acquire assets at a cheaper going in price to generate the same amount of returns, or two, we need to lower our return expectations. So now let's look at some of the responses and some of the data that were encapsulated in the survey itself. So the first thing that we noticed was that it was really surprising the modest amount of cap rate decompression that the survey suggests. While capital structure and the cost of debt is usually the greatest influence on cap rate movement, we think there were a few different things that played into this modest level of decompression, given this huge backup of interest rates. Number one is the fact that there is just so much liquidity out there. There are a ton of new players in the last few years coming into this space, and some of the things that we've seen are also large institutions reallocating away from commercial real estate asset classes like hoteling and some more economically sensitive areas into what's held up generally well during the pandemic, which is multifamily. In addition to that, last year, some of the cap rate survey was probably a little bit tainted by the fact that there was a ton of assumption debt and assumption deals going on. And this is where a new buyer takes on the existing owner's debt, in-place debt. And they sometimes do that because they can get more favorable interest rates on that debt. And so as a result of that, they're sometimes willing to pay more for the fact that they're getting that below market interest rate. We know from our own personal experience, we got into an assumption deal towards the back half of last year, and looking at that same deal with debt at the time, it wouldn't have made sense. So that could definitely be the case as far as holding some of the cap rates down in many markets. In addition, there were a higher than average number of seller financing deals that happened, and that could also limit cap rate increases for the same reasons. Now, looking at the report more broadly, some of our top takeaways were the following. Number one, market activity was declining and declined for much of 2022 as interest rates backed up. There were fewer bidders and there were wider bid-ask spreads for properties. Now, the bid-ask spread is a difference between what the buyer is willing to pay and what the seller is willing to offer their properties for. Now, contributing to that diminished market activity and the wide bid-ask spreads were the higher interest rates, as we just touched upon, which impacted buyers' pricing expectations. So we were very much in a world of what they call price discovery, where buyers and sellers are trying to come to some agreement, but trying to figure out where the market stands, basically. A recovery in investment volume, according to CBRE, is going to require more stable capital markets. So it's going to require debt to really calm down, basically, and narrower bid-ask spreads in order to get back to the level of activity that we saw in prior years. Now, for the remainder of the year, survey respondents saw fewer deals being completed and reduced buyer interest. They reported similar findings for bids on multifamily properties. So, all of this volatility in interest rates and capital markets has really spooked some people away from the market and maybe prompted them to pull some chips off the table and maybe sit on the sidelines for a while. Now, our own observation is that we're seeing a lack of deals, with much more of them being priced off market, meaning a lot more of the deals that we're seeing are going directly to a broker who's going to maybe their top list of interested buyers rather than going on the market. So that's one real world impact that we're seeing as a result of that wide bid-ask spread. While cap rate decompression was more modest than one might expect, it did happen. Respondents expect yields to increase another 25 basis points, in fact, over the next 6 months. So on average, cap rate estimates are up 60 basis points from the first half of 2022 when their first half survey was completed. So again, just to repeat that, cap rates have backed up 60 basis points between the beginning of the year of last year and the end of last year, and the respondents expected to back up a further 25 basis points. And that all is, again, a function of the Fed's monetary tightening and wider commercial mortgage spreads. Now, in some markets, these cap rates are actually below the borrowing costs, which results, of course, in negative leverage. What does that mean? That means that somebody's going to be transacting in a property and accepting a lower cap rate, essentially a lower return, than they're having to pay out in borrowing costs. And why would they do that? A, they think that they can potentially refi out at some point down the line when they've executed on their business plan. Or B, they can potentially increase and improve the operations of the property, thereby pushing the cap rate to a higher level where there will be positive leverage. That is, they're making more money on the property than they are paying out on their borrowing costs. Now, looking forward, CBRE's economists say that they believe interest rate hikes and cap rate expansion is going to peak later this year and then finally start to decline in 2024. Now, that's also agreed upon by the bond markets, which are pricing in interest rate declines actually later this year. So only time will tell there. Now, the respondents also assume that there will be lower rent growth over the next several years. For anybody that's been investing in the last few years, they know, and anybody that's been investing even prior to that would really recognize the fact that the last few years that we've had in terms of rent growth have been unprecedented, at least in our lifetimes. In many markets, we saw 10, 15, 20% plus rent growth year over year, and that's just not normal. So, on the heels of all that record rent growth, a lot of the respondents believe that the next 3 years will be a lot more modest in terms of rent growth. Now, 60% of those respondents said that the next 3 years will be somewhere between the 2 to 4% annual rent growth on average. We think that's a lot more in line with historical averages. And in some of our deals that we're looking at and making offers on, we're actually assuming that's going to be at the lower end of that realm. Now, one of the other things that the survey touched upon was the amount of supply that's coming online. There is, in fact, a robust supply pipeline in the multifamily space. Even despite that, the industrial and multifamily sectors were picked as the number 1 and number 2 performance sectors for the next year. So while there's a ton coming online, it seems that many of the respondents believe that there's such demand, such liquidity out there for multifamily product that it's going to overwhelm or outweigh any supply that's coming online. So we hope that you've gained some understanding and appreciation of the market from our takeaways on this CBRE cap rate survey. Now, looking forward, we believe that this year is going to be particularly pretty difficult for operators to find good deals in. And it's going to be hard to really come by those deals with just tons of meat on the bone. These last few years, there have been a lot more people that have come into the space, and for that reason, we believe that value add, it's going to become more and more difficult to find real value add properties. And combine that with the fact that there is more uncertainty today in the capital markets and in the economy. And I think it's going to pose a little bit of difficulty for us as operators, but this is where you want to be patient. This is not where you want to be aggressive and overpay. These are the markets where you really want to tread carefully, but that doesn't mean that you should be sitting on the sidelines. Us as operators, we're still making offers on deals, albeit at 20 to 30% discounts from where the sellers are looking to transact. But it's important that you stay active, and in these markets, it's important that you communicate with your team members. And that includes your lenders, your brokers, your insurance brokers, your property managers. During times of turbulence, that you really want to over communicate with your team members, because information is really the lifeblood of this business. And the more that you can stay in contact with them and with updated on market developments, the better and more equipped you're going to be to weather the storm. And we do believe that there may be storm clouds gathering on the economic front. But again, all of these challenges present opportunities to the savvy investor. And so, again, we hope that you've taken something from this CBRE rate survey. We'll go ahead and include a link in the show notes to this episode, and we look forward to speaking with you. As we always say at Maple Capital Partners, be kind, be charitable, and invest wisely. Thanks, friends.